Let's look at inventory analysis. So it's important to be efficient in inventory because when inventory sits around, you're not selling it. So you have funds tied up in the inventory because you spend money to buy inventory. Then if you're not selling it and sitting around, you're not selling it and getting your money back. It's just tied up. Another key for inventory efficiency is pretend you're a computer shop. You sell computers. Stuff sits on your shelf for 3 years and becomes obsolete and you can't sell it. And it impacts liquidity because when you buy inventory, you use up cash, which impacts liquidity. When you sell inventory, cash comes in, impacts liquidity. A couple key measures we look at is inventory turnover and number of days sales in inventory. And if these look familiar because they're a lot like the accounts receivable measures we looked at before. Inventory turnover is how many times we turn over our inventory. Number of days sales in inventory is how many days inventory sits on the shelf. So inventory turnover, first thing we have to calculate is average inventory. So we take our beginning inventory plus our ending inventory, we get 547,000. Divide that by 2, our average inventory is 273,500. We divide our cost of goods sold, 1,043,000, divided by that average inventory, we get an inventory turnover of 3.8 times, which is a whole time better than 2011. So we improved our process to turn our inventory over year. Now we want to calculate days sales in inventory. We take our average inventory calculation on the previous slide. Now we're going to take our average daily cost of goods sold. So we'll take our cost of goods sold of 1,043,000, divide by 365, and we get 2,858 average daily cost of goods sold. We divide our average inventory by the average daily cost of goods sold, and we get 95.7 as number of days sales in inventory. So that tells us that in 2012, inventory was on the warehouse or on the shelves for 95.7 days before being sold. But it's still an improvement over 2011 by quite a bit. It was 132 days in 2011. So year over year, the company improved its ability to move its inventory faster. So fixed assets to long-term liabilities. So we're talking about long-term debt holders. So these are, you go get a 30-year mortgage or you sell a 20-year bond. They're not looking at current assets and current liabilities. They want to look at the long-term impact on the company. So long-term assets and long-term liabilities. So the ratio here is pretty simple. Fixed assets divided by long-term liabilities. So we look at 2012, our fixed assets, 444,500. Our long-term liabilities were 100,000. So our ratio comes out to 4.4. That means you have $4.40 of fixed assets for every dollar of long-term liabilities. But you look at 2011, it was only 2.4. So there's been an improvement from 2011 to 2012 to give it more margin of safety in the future. That's what you get here, 4.4 to 2.4. It's a margin of safety long term. So we want to take a look at now ratio of liabilities to stockholders' equity. So it's the margin of safety for creditors. And also ability to withstand adverse business conditions. So ratio is pretty simple here. Total liabilities over total stockholders' equity. So what this means is that if your liabilities are more than your stockholders' equity, if the company were to go bankrupt, it's giving security to the creditors to know that might be something left for them in the end. So if we look at the ratio, take total liabilities divided by total stockholders' equity, we get 0.4. So for every dollar of liabilities, there's 40 cents of stockholders' equity. 2011, it was 0.6. So you want this number to actually go down. So when this ratio goes down, you have less liabilities to stockholders' equity. There's actually a higher margin of safety for the creditors. So number of times interest charges are earned. So it's the financial strength of the business. So we take income before taxes plus interest expense over interest expense. So if we calculate out our income before tax, we add back our interest expense. So we take our amount available to pay interest of $168,500 divided by 6,000, our interest expense, we can pay our interest 28.1 times. So this is an important one for creditors to look at, because when you give a loan to this company, you're going to want them to pay interest on the loan. This shows that their ability to pay the interest. So you look from 2011 to 2012. 2011, they could pay the interest 12.2 times. 2012, they can only pay the interest. They could pay the interest 28.1 times, which is better. So this is a safety for creditors, because they know that the company could pay the interest charges, and that's how banks and creditors make money.